Welcome to NextGen Money Trends, where we make complex financial concepts accessible and actionable for the next generation of wealth builders. The Fed just cut interest rates for the first time in 2025, down 25 basis points to 4% to 4.25%. But before you get excited about lower payments, let's look at what this actually means for your money. Let's start with your credit cards. While some variable rate cards are technically tied to Fed rates, credit card companies barely pass along cuts. When the Fed cut rates by a full percentage point in 2024, average credit card APRs only dropped from 20.74% to 20.27%. That's less than 0.5%. So don't count on meaningful relief from your credit card debt just because the Fed cut rates. Now, mortgages are a different story. Rates have dropped to around 6.39%, triggering a 58% surge in refinancing applications. If you're sitting on a mortgage at 7% or higher, this could save you real money. A $400,000 mortgage refinanced from 7% to 6.4% saves about $140 per month. But here's the catch. You'll need good credit, sufficient equity, and $3,000 to $8,000 for closing costs. Plus, these rates are volatile and might not last. If you qualify and the math works, you may want to act now rather than waiting for rates to drop further. And finally, your high-yield savings accounts and CDs will likely see rates drop. Banks typically follow Fed cuts by reducing what they pay savers. That 5% high-yield account might drop to 4.5% or lower over the coming months. The good news? Online banks and credit unions often keep rates competitive longer than big traditional banks, so you'll want to shop around rather than just accepting whatever your current bank offers. Now, understanding these impacts is important, but here's what's more important: why the Fed felt they needed to cut rates. The answer? The job market is showing some concerning cracks. In fact, August added only 22,000 jobs, barely enough to keep up with population growth. Jobless claims are fluctuating and job openings are declining. This matters for your finances because economic weakness affects job security, wage growth, and overall financial stability. Here's your action plan. First, don't wait for credit card relief that isn't coming. If you have high-rate debt, look into personal loans or balance transfers with promotional rates. These might offer better options than hoping your credit card APR drops. Second, if you're a homeowner with good credit and equity, run the refinancing numbers now. Use online calculators to see if the savings justify the closing costs. Third, for your savings, high-yield accounts will likely see rates drop, but they often stay competitive longer than big banks. Don't automatically accept lower rates without shopping around. The Fed may cut again in October and December, but they're moving cautiously because inflation is still above their 2% target. Don't bank on dramatic rate drops. Bottom line, this rate cut has mixed results for your wallet. Mortgages might get cheaper if you qualified for refinancing, but don't expect your credit cards to budge. The bigger concern is the weakening job market that prompted this cut. Focus on what you can control. Pay down high-interest debt, take advantage of genuine opportunities like refinancing if the numbers work, and keep building your emergency fund. Economic uncertainty means preparation matters more than hoping for rate relief. Thanks for watching NextGen Money Trends. If this helped you understand what Fed cuts actually mean for your finances, hit that subscribe button and ring the notification bell. Until next time, keep building that next-gen wealth.